Good morning, good afternoon, wherever you are. Thanks for joining us today. My name is Moose. I am the investment manager at the venture capital fund at TheVentureCity. Um, if you don't know VentureCity, we are a new venture capital model where we not only have a venture capital fund, but we have a growth accelerator attached to us where we support our companies operationally through our operational partners. Um, that we really believe in, but they are just too early for the fund. So that is just a very high level gist of it. Now, the VentureCity covers both North America and Europe. Given that I'm in the Madrid side, I take care of the European side of things. On the venture capital fund side of things, we invest in pre-Series A to Series A startups, and we are looking for software companies. We don't do hardware. With two core characteristics, we look for founder mentality and we look for potential for internationalizations. We invest between 1 to 4 million per ticket, and we look for startups in US and Europe primarily. So that's a bit about TheVentureCity and what we do and the fund itself. Now, I am just going to dive right into it. Seems like most of the people are here. So what's the agenda today? So the agenda today is we're going to cover four main things. How VCs make money, which is crucial for you to understand, because after that, you have a bit of more context on how we make our decision making and how we think about our why the decisions we take, why we do it, and why some decisions are more crucial than others. And the last point will be, as founders, how can you sort of like use it to your advantage when you're engaging with VCs. Having said that, if you have any questions, please feel free to use the Q&A feature, and I will get to it promptly. And we'll also have time at the end of the session to take your questions if you see fit. All right, so let's get started. So before I sort of like, right before this presentation, I looked at, who is sort of like signed up and who is my target audience. And it seems like, the majority audience is either a founder, CEO, upper management, or an investor, or someone who is interested in becoming an investor in the, so given that, that's our core audience, I will be focusing my conversation today on the founder VC dynamics. But by any means, if you have any other questions or if you have any particular point that you want addressed, please feel free to let me know, and I'll address it as soon as possible. Now, I just want to manage the expectations that, if this session will be focused primarily on, the global VC firms on the early stage venture game in the software tech sector. So by that means, we are not looking into the growth equity, private equity sort of things. We are not looking into, healthcare or clean tech VCs. We're not looking into the late stage, because frankly speaking, if you are here, you're likely an early stage investor or startup. Otherwise, you would know how the VC game works already. Now, this session will not be super technical, like a walkthrough of a deal, and I won't be going through very technically or analytically in a portfolio management strategy. But I will be touching on it because it's crucial for you to understand that, to understand how we think. Now, I also won't be covering any due diligence and associated frameworks in great detail, because that could take up a whole session on its own, and that is not the purpose of our conversation today. That could be another session on its own. So now that we have set the stage, I just want to make sure you understand why we are here and why it's important for you to understand how VCs think. Now, essentially, I've been a founder as well, and I have now, I'm on the other side of the table where we deal with founders on a daily basis. And essentially what we have realized is that, at least what I realize is that, as VCs, we interact with when we're interacting with founders, there's a clear disconnect between us and the founders. On they don't understand how we think or why we think or why, what are the motivations, or like why we see a certain startup as too small versus when they think it's sufficiently big enough. So to help bridge this gap today, I'm sharing a few psychological drivers that predictably dictate many VCs' mindset and decision-making processes. These are patterns that founders often fail to see, and my hope is that you can learn them to master the skill of founder VC communications. In my experience, in my belief, for us as a founder, understanding VC mindset is often as more important as understanding the mindset of your customers. Why? Because with no capital, most founders will not meet. So you better understand where your capital is coming from and what will get you the capital. Now, to begin, perhaps the most efficient pathway to understand, anyone's mindset is understanding their pain points. So given that, we're looking into the VC side of things, it's important for you to understand what are our main pain points. And as you will see, being a VC is not really a simple role. All right, so to understand the main pain point, you need to understand how we make money. If you understand how we make money, you understand, what are our main dilemmas. So if you're not familiar with it, we see a venture capital fund, where we stand in this picture is, we are the GPs. We have a fund vehicle where, we have a pool of money given to us by the investors and the LPs. Now, the LPs are, institutional investors, funds of funds, pension funds, government, billionaires, anyone, who has a lot of money and, willing to give us money. We take that money, we pool it into one fund, and, some companies have multiple funds, but what's common in that, each fund invests in multiple companies. And the way we make money is that two ways. First of all, we take management fee of 2%. So let's say if it's a $100 million fund, then we are going to get 2% per year. And this is essentially for us to cover our operating costs. Now, where the real profits lie for the management fund, venture capital fund, and the venture fund management is in the profit sharing. So essentially, let's say we have the $100 million fund, and at the end of, let's say, 10 years, we close that fund. That fund, we exited all our companies, and that fund is now valued to $300 million. So out of that, $100 million will go back to the investors because that's a capital principal. And then out of the $200 million profit, we have, 80% will goes to LPs, and the fund will get 20%. So that is essentially, the math behind how we make money. Now, here comes the power law. A power law, if you're not familiar with it, essentially is like 80-20 rule in simplification, right? Essentially, in the venture capital game, you have 20% of the companies or 10% of the companies bringing 80 to 90% of the returns. That's just how it is, and I'll show you some data to back it up. So when you have that sort of like distribution where you're not looking at the normal distribution, where you have an average, you're not dealing with averages but extremes, your thinking changes a bit. You're looking for that one outlier or that one company that can bring you the return. And every company, when we look for and we invest, has to be that company. Just to throw some numbers out there, just to sort of like back up, and these are some numbers covering the entire venture capital industry in North America. Over the last 10 years, 2.5% of the venture deals that were done generated almost all of the industry profits, and less than 5% of the capital, generated 60% of the fund profits or the dollar figures in top tier funds. So the top tier funds are, the funds that you usually hear about when you think of a VC firm. Andreessen Horowitz, Kleiner Perkins, Union Square Ventures, Benchmark. These are all the Silicon Valley pioneers in venture capital funds. So even for them, the power law stands true. Now, what is the difference between an average VC firm and a top tier VC firm? Essentially, that they just get a higher outlier rate. than us. So if they have 100 companies, 4 of them will be outliers or a billion-dollar company, while an average VC firm there will be 2 companies out of 100. But still, the power law stands true. Moving forward, if you look at the entire VC industry, there was a survey that was done looking at around 700 venture capital funds globally and primarily in US, and they looked at, okay, what percentage of companies or exits drive what percentage of multiples. So multiples is essentially, the money you invested, the money you returned over the money you invested. So if you're returning $300 million fund for $100 million initial fund, your multiple is 3. And what they realize is that, almost 60% of your companies or exits were less than 3x multiples. So you only got $3 back out of every dollar you invested. There's only 1 in 10 chances, or just a 1 in 10 chances of hitting that 10x plus multiple. Now, where you might be wondering, where are these multiples coming from? What is 10x? What is 3x and all that? So this is where you have to understand the motives of people who are giving us the money. So if you are, let's say, if you're a billionaire, right? You have so many options to invest money. You can invest money in the stock market, in real estate, in arts, in other private equity funds, in funds. You can give direct money to the founders. The options are numerous. So when we look at when you're giving us money, you're giving us money for 10 years or more, and you're locking that money up, so you're not going to see that money. So if you are giving us money over investing in investing in public markets like S&P or Nasdaq, and you're locking that up, the return you have to be expecting is much more than the return of the public markets. And just to sort of like compare, so I'm going to step back a bit. So when it comes to the early stage venture capital fund, where we are based, the minimum multiple that the founders are expecting or the LPs are expecting are the 3x. So if they are giving us $100 million, they're expecting back $300 million. And I'm gonna tell you why. And now, if you convert that into like rate of return or percentage per year return, that equates to around 20-25% annual return rate of return. So this is why the 3x. This is where the 3x is coming from. On the other hand, we also give money to the founders or to the companies. So our criteria is much higher. We are not expecting 3x. We are expecting 10x because we have to, that has to compensate for all the companies that are going to fail. So our multiple requirements are higher, and also our rate of return is higher because we are not investing for 10 years. We're investing for 8 years because there's a likelihood that, the investment period will extend. So we need to account for that as well. And as already mentioned, the venture capital is a very high risk game. So there's a lot of sort of like potential or probability that we're going to lose that investment. So we have to compensate the probability of loss with the target multiple. So all this math is sort of like going in our head, and it's built into our portfolio strategy, which defines the type of companies that we look for. This math is not going to happen, when you look at you. This math happened already when we sort of like establish our fund, and based on that, we establish a criteria, and based on it, we establish, we're going to be saying, okay, this company makes sense, or this company does not make sense. And that's essentially what happens. So going back to, just to give you some perspective, if you compare the S&P, which is like, the signature stock market index in US, with the VC returns in the median and the top VC, you will see that, if you are just a middle of the road VC, your return over the last 35 years is just on par with the market, or even under in the market. So it wasn't really that fruitful for the LPs to invest in VC, lock their money up in the VC asset class over public markets. But nobody in the market, or no fund in the VC industry is trying to be this average. They're trying to be the top quartile and hit above the market. So that's why they are looking into, they're looking for 20%, 25% rate of return annually, and this essentially, converts into 3x multiple or more. So just to give you some perspective. But I mean, if we had 10 companies, and if all the companies, were able to return us, 10% equity, or if we invested let's say we have $100 million fund, right? And we invested like $2 million in 10 companies, and at the end of our venture capital investment horizon, they returned us 20 million at 10% exit valuation, or 10% exit stake. That would have been phenomenal. But the thing is that, it's not going to be like that, because you will have companies that will fail. And even the companies who are successful, your investment is not going to be 10%, it's going to be diluted. So here what I'm showing is that, it's sort of like the projection we did for an actual investment that we were considering like a few months ago, where, the valuation where we were looking at was like 30 million. And then we figure out, okay, what the investment would be, or what the valuation would be, in Series A, Series B, Series C, Series D. And if we invested right now, based on our investment ticket, we're going to probably get to 20% ownership, and, how would that dilute? So if you look right here, by the time Series D happens, and by the way, it's Series D because, we expect the companies, we expect to hold the companies or hold the investment to at least 8 years, right? And it usually takes around 8 years to reach Series D level. It might even be Series D if we expect to reach Series, hold the investment to 10 years, just because we feel that, we can get a lot more upside, a lot more return out of it. So let's say, it's Series D, and we expect, based on the revenue projections that, it's going to be a 1.6 billion company. So we're going to dilute around 60%. So at 8%, with a $1.6 billion, 1.6 billion valuation, we are expecting to return around 120 million. But this is like a very, very idealistic scenario, but it's easy. I use this because it was easy to understand, how the dilution works. But the same is going to be happening, if we have a 10% or 5% ownership, right? And essentially what is going to be determining our one of the main determining factors would be, what is the entry valuation? If we have, $2 million, in this case, we could be investing $6 million, 30 million, 20%, $6 million. But let's say, the valuation was 15 million, we could have 40%. So our returns would have been, instead of 120 million, they would have been 250, 300 million. So that would have been enough on its own. So that is why, the valuation comes into play, or that's how the valuation comes into play into our thinking process, and I'm going to get to it a bit in a few slides on what exactly that means for the founder. All right, so let's do a very quick example of how, how this all works, and just so you understand, how we're looking at the investment. So let's say, you are talking to a VC, and the VC has $100 million fund, Out of that, 2% per year is going towards management fees. So they only have up to $80 million to invest. It's not even $100 million. And so out of that $100 million, you always have a pool of initial investments and follow-on investments. So follow-on investments are essentially investments that you make into companies that are already in your portfolio, that you believe are going to be winners, that you believe are going to grow, that you believe are going to make your returns and all that. So, and you do follow-on investments to maintain your stake or even increase your stake in the company. The higher the stake, the higher the returns would be. So, but at the end of the day, what's going to be driving how much money or how many companies you can sort of like have in your portfolio are your initial investments and investment per ticket size, right? So let's say in the VC's case that you're dealing with, you have 48 million in initial investments. So let's build a portfolio, right? So, you have, let's say 18 investments that they have made. And on average, this is a very simplified model, but let's say, they make 18 investments, each of them, they targeted 20% ownership. The entry valuation is somewhere between 10 million and 20 million, the sweet spot between, around for a pre-Series A to Series A investment. So you're on average, you're investing between 2 to 4 million per company, depending on your entry valuation of the company. So, and then, so you have 18 companies. Out of them, over time, let's say in year 5 or 6, you realize, okay, this company is doing good. This company could grow. This company has an acquisition potential, whatever. So I want to double down on them. So you identify 6 companies and you do follow-on investments. And that's where you exhaust your follow-on bucket of $32 million, right? So that's done. Now, the dilution is going to be, you're going to hold the companies on average, let's say 40 to 60%. Sorry, you're going to hold the companies for like 8 to 10 years. That's going to mean, 40 to 60% ownership, assuming, you invested in the seed stage or pre-series A stage, right? Very early. Which means that by the time you're done, your 20% stake is going to reduce to 8% to 12%, right? Now, what happens with the exit valuation in your returns, right? Now the power law comes in. We're going to have certain companies that are going to be doing very well, and certain companies that are not going to be doing so well. So let's say, here's the exit valuation of certain companies. As you see here, you have 3 companies that became unicorns, or that became more than $1 billion company. Then you have a middle of the road companies between 100 and 500 million. That's your like mid tail. And then you have 8 companies that failed, that did not return anything, even though you invested at least half of your money in those companies. So this is reality. This is how it's going to look like. So your exit valuation of the fund itself, it's going to be around $600 million. But this is what you haven't taken into account, is that you're assuming here that all of these exits are going to materialize. And that's not the real world. The real world is that you're at least 50% of the exit prospects are gonna not materialize. That might be because the market evaporates, or something happens with the company itself. The M&A opportunity is not as sweet as you expected. The valuation is not as sweet as expected. There are like a whole bunch of scenarios. So on average, 50% of the exits don't materialize. So the 600 million that we were hoping is now around 300 million. So that is the 300 million that we are going to be able to sort of like recover from our $100 billion investment. So as you can see, here I just want to give you an idea that, hey, it's very difficult to sort of like really hit that 3x, at least 3x, unless you happen to be an investor in Facebook or Airbnb, and or you are sort of like you have an extremely good deal flow. Most of the exits are going to be much smaller than $1 million, and the chances of any fund getting to 3 billion of exit value are not that high. So what does it mean for you? What's the outcome of these 2 numbers? Essentially, these 2 sort of like distill into like the 2 pain points that VCs deal with, that are, as founders, are critical for you to understand. The pain point number 1 is that VCs need really large exits and we are always looking for these really large exits. It's not a $100 million exit. We are looking for $1 billion or more. In general, it's very tough to return the fund multiple times with our strategy. So most VCs you will meet will be very serious when they tell you, hey, I love your startup, I love your product, I love your team, but I don't believe your business is worth more than $100 million. And you're going to be like, but $100 million is a pretty big market, but it's pretty good market for you, but not for us. So essentially, this is why, hopefully I gave you some context on this is why, the market, we are looking for really big numbers. It has to be, it might be $100 million revenue, but then your market has to be really hard to make it into a $1 billion valuation or more. Otherwise, it's just not gonna cut it for us as VCs. Now, the second pain point that you need to keep in mind is that we need large stakes in the company. We need big ownership in the company. Now, the venture business is a hit-driven business. Every successful VC fund will have 1 or 2 big hit companies that, quote unquote, make the fund. Essentially, they return the fund and then return some more money to the LPs or to the fund. So while everyone, it's hindsight is 2020. You clearly knew, looking back, that okay, this company was great, it was a great investment, but we don't know this at the time of investment. So how do we sort of like deal with this? So the outcome, the way we deal with this is that we need to get sufficient holding in or ownership in every company that we invest in, which is usually at least around 10 to 15%. And I'm talking about an early stage company, I'm talking about like seed, pre-series A, up to series A, that sort of like level. So we shoot for 10 to 20% of the company. Now, if you're a VC, imagine what happens. Imagine how much it's going to hurt if you only hold a 3% for a company that could have returned your entire fund. That is going to be a big regret or a big loss, right? And the lower the percentages of holdings, the higher the overall exit. And this is essentially goes back to your valuation. That if you think you have 20 million valuation, and we can only invest like 2 million, and which means we can have 10% of our company. That means that if you can only make it a $2 billion exit, if we feel that you can make a $2 billion exit, then it's going to make it. Otherwise, you can be a $1 billion exit, and it's going to be phenomenal, but it's just not going to cut it for us, right? So that is how we sort of like think through the opportunity and all that. All right. So once you understand the 2 pain points, now let's move forward with the VC decision-making process. Now, now that you understand the numbers and the pressure we have to get sufficient holdings in the companies, I want to give you a sense of how tough it is to actually find these companies. So, for you to understand, a VC fund is structured in investment partners or investment professionals and non-investment professionals, right? So investment professionals are, general partners, associates, and the non-investment professionals are, operating partners and anyone else, right? So the way it works is that, VC funds will have a team of junior partners, associates who spend a lot of time deal sourcing. They're out actively finding interesting projects and bringing them in. And you also have a number of projects, that would come in through online channels such as email, website, LinkedIn, you name it. So a partner or a GP, will review the companies that junior partners or associate will think are important, And also, GPs have their own network, and if a trusted source, if an opportunity comes through a trusted source, somebody who knows GP very well, who has recommended the project to them, the GP will take the deal directly. So once they think that the deal is interesting, they will have 2 different paths that they would follow. One is that they could either fast track it and say, hey, we need to and present it to the investment committee. And an investment committee essentially is the whole partnership. A fund is usually more than one partner. So they're going to bring in all the partners. They're going to bring in all the operating partners, all the management, and present it to them, right? And the general partners or the investment committee will decide whether or not to proceed with this in an aggressive way. And if you remember this point, because this is going to come in later, right? The other way is if it's not an aggressive way, is that they can take their slower track, which is to do some due diligence. They maybe have some multiple internal meetings with the management to sort of like clear any questions they might have, and follow their proper due diligence process, right? And once that is done, they would put together a package that addresses those points and then present it to the investment committee for a vote. There would be a presentation by the founder, the whole partnership. It would be the partnership will discuss, meet, and tabulate. What they think are the strengths and weaknesses and the risks and opportunities are. Of the projects and the investment and all that. And then that's essentially how they move forward. Logistically speaking. Now, whether or not it's a unanimous vote or you need one partner, it depends on the partnership. Some fund will need everyone to say yes. Some fund just partner can go ahead without any sort of like majority. It all depends. But essentially, this is how the sort of like the high level semantics work when it comes to deal flow. Now, essentially, once you have okay, from your perspective as a founder, what you need to understand is that from a deal sourcing perspective, inbound perspective, a VC partner is all about, 3 things: screening potential investments, diving deeper into the better deals and eventually choosing the right companies to invest in. For you, this is what you need to keep in mind. Now, it might seem that it's not probably a horrible job, but it's also not an easy one. As VCs, we are getting like tens of meetings and investments requests every day, and it's never clear to us, to be honest, where the next great company is going to come from. So we need to review all of them. And even though there might be some decent ideas and some great teams, we only get to invest in, like, let's say, one company. Well, a typical VC would only get to invest in one company out of every 100 companies they see. For us, this number is quite different. And for us, I mean the TheVentureCity fund. And that it doesn't even include, saying no to the 99% of the companies that we look at, because it's just not possible. It just doesn't cut it. So just to give you an idea of, the deal flow, just to give you an idea of where we're getting our deal flow from, our deal flow is coming from a lot of different sources. But for you as a founder, what you need to understand is that, it's going to be coming from, majority of the deal flow is coming from, our professional networks, other investors, or our portfolio companies, outside of that, we will proactively, sort of like source it out. We are gonna, our company colleagues will gonna pass it on, or we're gonna do some, let's say, some AI quantitative sourcing through PitchBook, current space, to source it. But for you, if you need to sort of like get into the game and get in front of the VC, what you need to do is, rule number one is that, source introductions from portfolio founders, angels, VCs, whoever. Sort of like, it's like, think of it like a job search. The best way to get your CV in front of a recruiter or get the interview is that, either have a referral or have someone know the hiring manager or any other, right? The same sort of like logic applies here. That if you want your best shot at getting the top of the pile, and I'm talking from personal experience, is that get a referral, because that we decide to spend more time in them because we trust the source. Okay, so that's one. Now, once you have, once you're at the top of the funnel, essentially what's gonna happen is that, we're gonna sort of like look at the deal initially, and a quarter of them or a third of them, we're gonna actually decide, okay, let's meet the founders. Once we meet the founders and we like them, a third of them, will move forward with, some sort of due diligence and a call with the entire company. And oftentimes it's around half and half, where we decide to do due diligence, proper due diligence, and other half, we decide to not continue. And usually, depending on the company, a third will be offered term sheets, and once a term sheet, we do legal due diligence, and again, depending on the fund company, it might be 80%, it might be 30% that make it to the final investments. For us, it honestly depends on the sort of like the vintage, the year, the quarter. It could be in some quarters 80% of the due diligence we did, they ended up being the investment. Otherwise, in sometimes it was 1/3 or not even one. So it depends. Now, I promise that, I'll share our numbers. So I'm going to share that, over the past sort of like 16 months, it's pre-COVID numbers. We looked at 5,000 companies that went through our pipeline, and this is like different levels of engagement. Some of them we just screened and said no. Some of them went through as far as, investment committee. But we touched 500,000 companies, and out of them, we invested in 4 companies. So you can see it's not even 0.1% success rate for us. Just because, our top line is so bigger, and the more the companies we see, the better we are at sort of like screening and sourcing the best deals possible. So just to give you some sort of an idea. All right, so now that you know that, what are the how we make money and what we need to do to make, find those deals that will make us money. It's important for you to now understand, psychological drivers that we develop to cope with our pain points. Now, again, just to refresh your memory, our pain points are: 1, that we need really large exits, and number 2, that we need large stakes in the companies. So the first psychological driver, is fear of missing out, or FOMO. I didn't make this up, but essentially this is what it boils down to, the FOMO. Basically what happens is that, you always hear about VCs sharing their big wins, but what you don't get to hear, or what most people don't know, is that uh, every VC will have stories of their big losses, the deals that got away, and they come with some really deep personal regret. And while some of this, is based on lost financial profits or benefits, obviously, more often these regrets will go a lot deeper. Big hits are so far apart. You have to find that $1 billion company. So if you lose that one, you really regret it. So, having, if you had if as a VC, we had the option to invest in it and we missed out on it, that is our biggest fear, that not to repeat that mistake again, And to be honest, at TheVentureCity, we also have missed out on a couple of deals here as well. And honestly, I can tell you that thing comes back every single time we have a deal on the table, And it's really what drives us to sort of like get through the company, get through the deal faster. If it's a really hot deal, close the deal, and that is essentially what drives sort of like the very heated debates within the team. So when you see a company which could be a huge, with great team in a field we like and good idea, it's very tough not to invest. So that's essentially the first psychological driver. The second one is, fear of looking stupid. I couldn't come up with, like a better acronym. So, just let's roll with it. But essentially what happens is that, as VCs, we are programmed to maximize our returns. That is our job at the end of the day, to maximize the return of the fund. But very few people talk about the VCs, are programmed to avoid looking stupid and hearing, I told you so. Looking stupid in the eyes of other partners, in the eyes of other VCs in the ecosystem, but most importantly, in the eyes of our LPs. If the LPs think you're not good at making investments, or you have made some stupid decisions, your reputation is gone, and you won't be able to raise another fund, or you're going to have a very difficult time. So it's very important. So, and what does it mean to look stupid? Essentially, it's all about making an investment that was too risky. And as we see, we did not mitigate the risk. Essentially, for example, if I were to give you some examples, like investing in a company that competes with a very successful company. For example, like who wants to invest in a social network today, right? Even though, I can tell you that I still see social networks, but that boat sailed like 15 years ago, 10, 15 years ago. So if you're thinking of social network, don't think of that. Another example would be, is investing in a field where a top fund has already already invested in a competitor. For example, it's not really applicable now, but maybe 5 years ago, you wouldn't want to go against Slack, with Climate Perkins or Benchmark and Uber, those sort of things. Or investing in a field where a competitor raised a very high amount of money. For example, any company that sort of like was invested with SoftBank, or a Magarant, what ended up happening was that the competitors were having a very hard time sort of like raising money or keeping money to compete with the main competitor, because the competitor just had very deep pockets. So essentially what it boils down to, that as we see is, I don't want to invest in anywhere where I could end up looking stupid. I don't want to answer to the LP when he's asking me, hey, why did you invest in an Uber competitor when Uber already raised $5 billion? So it's kind of like you also don't want to miss on a good deal, but you also don't want to take a very risky bet. So that's sort of like what I'm trying to balance at the end of the day. So what does it mean for you as a founder? How can you use it in your favor? Essentially, it boils down to this, the VCs want to find a very safe deal at a very low price of a very risky deal. What does it mean? It means that, obviously, we want to invest in the next $1 billion company, which means a huge opportunity will come with a very high risk, which is fine. As long as I can sort of like mitigate this risk, or I know that this risk is taken care of. And that is where you're going to help me as founder. Now, at the low price, essentially, is that, if I find a very good deal, a very good opportunity, and I think that, the deal is, the risks can be mitigated or contained, I'm going to double down on it. So I want as much of that company as possible. And that's where the low price comes in, So essentially, when you're in front of a VC, that's essentially what he's trying to do. He's trying to find the next big thing without a lot of risk and at the best price possible. So once you understand this, what does it mean for you? As a founder, you need to use FOMO to your advantage. We tell this to our own companies. We tell this, and this applies to us as VCs. This applies to all other VCs. When you are interfacing with VCs, time is not your friend. It's the VC's friend. So the VC will always prefer to wait to make their investment decisions. They are sort of, the longer they wait, the more data they will gather about your business, and the more they will get to know you. And this data means low risk. Again, we want to minimize the risk. It's in our best interest as VCs to keep the optionality. I can always say no to you later. It's not going to hurt me. But you, on the other hand, as founder, you need to be funding now to grow your company, to move fast, obviously. And you should also know that every day that passes gives me as an investor the opportunity to hear a negative or mixed review of your company, of your market. And that could give me, cold feet, or that could get me to say no. So as founder, you want me to close the investment or fundraising as fast as possible. So what does it mean for you? The only way for you to get to VCs or to get me to move at your pace is by going back to FOMO, because a VC usually only moves fast only when other VCs are also interested in your company. So what you need to do essentially is that when you're engaging with VCs, show me or show that VC that other VCs are interested. In journals, in journal founders, you guys should always aim to sort of like convey a sense of momentum. Hey, things are moving. Things are, I'm talking to this guy, or we are closing term sheets, or we are in advanced stages. As long as you are truthful, and you should strive to make this happen, so you can claim it and you can stand behind whatever you say to the VCs. Do it. Mention to VCs or investors that you are speaking to others don't disclose names, because you don't want them to talk to each other. So remember this rule as well. But let's say when you get to a term sheet, let everyone else know, that you got a term sheet to get them to move faster. The hotter your deal seems in the eyes of investors, the more likely you are going to be interesting to more investors. So oftentimes, you will hear founders say, or this is a good practice, is that you let the VC know that, hey, no pressure, but we are about to get a term sheet from so and just don't mention the name, get a term sheet early next week. And we would love to know, where you stand. As long as you can stand behind them, this is a great tool for you. Okay. So once you know how to use FOMO, the other thing is that, again, help me understand or convince myself and everyone else in my partnership that you are low risk. How do you do that? For that, you need to understand our investment criteria. I'm sure you have, sort of like, came across the investment criteria that VCs look for in detail, so I'm not going to go into detail. But essentially, when we are looking at, as early stage VCs, looking at the companies, we are looking for three main things. We are looking for team, product, and market, and this is applicable to any VC. Why is that? Because given we are early stage VCs are investing in companies that might not have monetized their product, or they might not even have a product or traction. The only thing they have is a team and a market, and a product, depending on what stage you're in. So if you understand this, you can use this understanding to flip the odds in your favor by simply convincing the VCs on the following three narratives, the team narrative, market, and product. And the better you portray or communicate these narratives, the more term sheets you get. It's essentially as simple as that. So now you might say that, hey, I'm too early, I don't have the product market fit, or I don't have the KPIs, or I don't even have the product, and this is a fair point. But from day one, you at least have a market and a team. You should be convinced and be able to sell these two things to anyone. So focus on that. So now I'm just going to give you some pointers that could help you sort of like de-risk yourselves in the eyes of investors. As when we are going through a deal selection, as VCs, we are placing a great importance to the management team. We do consider other factors, but the management team is one of the top two things. I would argue personally that it's the top thing. So when we are looking at a team, we are looking for the most important qualities that we're looking for in a team are, their ability to execute and make things happen, their industry experience or relevant experience, how passionate they are, if they have a experience being a founder and an operating experience, in another startup. And if it's a co-founder team, which is always a good thing, if they have sort of like history of working together to de-risk any sort of like team risk. So if you are a startup that, is pre-product, or it's, let's say, it's, you don't have a lot of traction, you can still work with team, you can say that, our founders are, very experienced and have worked in such and such startups. And essentially by showing me that, you are showing me that you're just not a strong team, but you also know how startups move fast and scale from your past experience. Or you can say, hey, our co-founding team or our management team have worked together for so many years before founding the startup. So essentially you're telling me, hey, there's no team risk. We know you guys know each other very well, and so on and so forth. So that's essentially, how to sort of like communicate or de-risk your idea when you're first meeting the investor. Okay, so I just want to share this one thing is that when founders, when we're looking at a team, there's a very good quote that I like from Ben Horowitz, who is, if you don't know, the co-founding of Andreessen Horowitz, one of the top venture capital fund. He's also the founder of Netscape, for those of you who are from the 90s. Essentially, he said that if you think about how do you get to the big idea, they call it earned secret. You did something in the past, you try to solve some hard problem, and you learn something about the world that not a lot of people in the world know. Essentially, what makes you unique? What's your secret sauce that makes you the perfect guy or team to solve this problem? So, and if you can communicate that, and this is, I can tell you, so many teams sort of like fail in that, even though they are at Series A stage, that there's something that you cannot ignore. The other thing is that, as we sort of like covered in the past, we are looking for big exits. So prove to me that you have a huge potential. Numbers play a big part in proving yourself. So make sure you're comfortable with that. Master your TAM, master your SAM, and come prepared with data. It's if you don't know what TAM, SAM is, Google it. You should know about different ways of sizing the market. Now, nobody's going to believe that you can take 50% of the market, so don't even go there. But essentially, you want to make sure that even if if you feel that you can, you can take 5% of the market, you have very huge or convincing story to tell. You can feel free to use references from other industries, like, the SaaS platform, the so-and-so SaaS platform for so-and-so vertical created like a multi-billion-dollar business. And the vertical we are after is similar in size, so we can build like a similar size business, something like that. So you don't have to, you don't have to be 100% accurate. Also, make sure that you do both top down and bottom up. So that essentially shows me that you know your market. Don't just say that, hey, we aim to capture 5% of the industry IT spend or so-and-so industry, right? Essentially, what you can tell me is that, hey, if you're doing bottom down, is that you will need 10% of potential customers who would need to pay you, $1,000 a month, etc. Whether this makes sense or not. If this is, if this makes sense, if this seems logical, then, and this sort of like jives with your top down, then that's credible. That gives you more credibility. Now, a question comes in that, do you need to be precise? No, nobody really cares. I don't know your numbers, and you don't know your numbers. And it's not gonna, we don't know how it's gonna pan out over the next 5 years, so we don't need to worry about that. But essentially what you need to realize is that as VC, I'm not trying to figure out whether you're gonna be 5 million versus 6 million in the next 5 years. I'm trying to figure out whether you're gonna be 5 million or 50 million or 100 million. So that, if you can answer that question relatively well, I think that will help me de-risk your opportunity much faster. And the last, before that, I just want to point out that there's a very good quote that also I like, is that market always wins, regardless of how good or bad you are. If you're a great team but a bad market, you're hopeless. If you're a not so good team but your market is great, you're going to ride the wave for a while. And I've seen that happen a lot too. But if you're a great team and a great market, essentially, you have a very good founder market fit. This is where I want to be. So the last point is, founder market fit. where, if you are, this is more so when you have a product or when you have a traction, I don't need to see a product market fit, but I want to see evidence that it could be possible, right? This could be many different KPIs. You could say, hey, we have 10,000 engaged users who use the app daily, which essentially, by which you essentially are showing me, you have some retention and some engagement. And you could also say, hey, we are started monetizing and my conversion to payment right now is 3%, which essentially means that there's no risk, or there's minimal risk that this can only be a free app. There's nothing worse than having a very high user metrics or engagement, but you cannot find a way to monetize it, and this happens a lot too. So make sure you always have an idea or a strategy of monetizing your product. The more data points you can present to prove you are lower risk, the better. But the main thing is that, and this is also keep in mind, is that funding process and funding raising will take time. It always does. So to ensure that you make sure you provide updates to the investors that you are progressing. Nothing shows that you are low risk like a fast progress over time. And that helps me. As long as you matches my criteria, that really helps me de-risk your opportunity. All right, so this sort of like takes me to the last final learning is that, if you are not familiar with founder KPIs, or if you don't know which KPIs, start by learning how VC sees your number. There's a lot of material out there. We could also, I didn't go into it in detail because of time limit, but if you understand, which VCs are applicable to you based on your business model or your market, and you work backwards to find the right data points that will sort of like communicate or back up your story, that will go a long way. And you should be able to do that from the get-go, because this will sort of like guide as your main metrics, as your North Star when you are building your business. There's some things, we have a lot of material on our blog. The lab team has done a phenomenal job in exploring this realm. So I encourage you to check out the blog on things like quick ratio, conversion rates, CAC, LTV, things like that. Again, it's going to be based on your business model. All right, so there are different, again, this is sort of like repeating what I already said. There are different frameworks to understanding, decision making. So I don't want to repeat it, but yeah, there's another one called 5 T's, which is like, team, tech / product, TAM / market, tractions / growth, trenches / competition. One thing we often see is that, do not use complicated financial forecasting techniques, because we don't do it. We don't, honestly, as a listed VC, we don't have a lot of numbers to sort of like forecast. So you don't worry about that. We sort of like protect our financial risk by using contracts and legal rights, such as liquidations and controls and things like that, which we will get to it in some other session. The other thing, one last thing, is that do not forget about your competition. Analyze them well. The better you know your competition, the easier it will be for you to convince your investors that you are low risk. And there's nothing worse than, sitting in front of a VC and telling me you don't have a competition just because either you don't know that you have a competition, or you just don't think you have a competition, and I know that. You're going to lose credibility so fast. All right. So the other thing would be, learning how to deal with rejection. This is a quick one. What I would say is that, more often than not, you're going to get a rejection. So make sure you know how to deal with it. Always I encourage you not to accept empty no, or not to accept no response. Always reach out to them, follow up. If they give you no, always ask you why, because it will help you build your case and build your story stronger and deal with the business gaps. All right, and again, don't forget the mantra. I just want to sort of like end it with my mantra. When you are out dealing with interacting with VCs, just communicate these 3 things. We are low risk, we will be huge, and others are moving forward. Are you in? And go get funded. That's all from me. Thank you. And I will see if I have any questions. Okay, somebody asked me about the Excel file used for the VC model. I mean, sure. I mean, it's pretty simple. I can share the Excel file. It's not that complicated. Then someone else asked me, if you get to know 2 company, amazing new and innovative product, Amazing new and innovative product, great feature, but not good metrics in that particular moment. Common product, not exciting, short, midterm future, good metrics. How do you guys evaluate this? And what would be most likely your decision if I had to invest in only one of them? Well, to be honest, this is pretty easy. If it's a common product, then it's maybe a commodity, or it's, there's a lot of competition. So I'm not looking for, run-of-the-mill product. I'm looking for the next big thing. Like I said, I'm looking for the biggest risk with the biggest opportunity. And I'm going to minimize the risk. I'm not looking for, I don't know what would be a good example. Like, I'm not looking for the next Uber, or I'm not looking for the next social network, even though I'm not looking for an ad tech company. Like in this day and age, given that we're in COVID, I'm not looking in travel tech. It's already pretty common. It's not very, it's not very exciting. I'm looking for, what's the next big thing. So this is pretty easy. What would you upload somewhere the presentation? I think, I'm not sure. I'll have to sort of like confirm with EMEA about the presentation, but we might do it on the website. We'll see. I don't have any other questions. I don't know, Eugenia, do we have anything else, or are we good to go? Oh, we have another question, sorry. Let me, how would you evaluate a huge opportunity, very much in deep tech with the technology defined, working on patents, but with no team yet? What will be the steps to in such a startup in not an ideal startup ecosystem? I mean, see, this is, I think what you're getting at. See, the thing is that I don't really care if you have a cool technology if you cannot build a business around it, right? So I don't, oftentimes we see, a startup or someone who has worked 3 years to develop a really cool technology, and they sort of like patenting it without even proving that, people will buy it or people will use it or you can make money out of it, Why would I be interested in that technology? You have to sort of like, unless, there's specific cases, it's a healthcare, you need FDA approval. No, fair enough. We have dealt with that sort of like dynamics. But if you're thinking like, oh, I'm going to develop this super cool technology, once I have a patent, then I'm going to release it, you know what? It's not for us. You need to show that you can build a business around it and people will pay for it, and then we are talking. So that's that. Any other questions? I still have time for a couple of more. Okay. All right. I guess that's pretty much it. Well, thank you for your time. Thank you for your attention. It was great. I enjoyed it personally, and looking forward to having another session with you guys. I'm not sure when, but we'll see. But all the best, and yeah, my contact information is right here. Feel free to send me an email, add me on LinkedIn, reach out to me on Twitter, and we'll take it from there. All right, guys, all the best. Cheers.